Today we are going to talk about these topics. Number 1. What happened to my money? Number 2. Bankruptcy law, some important facts. Number 3. Understanding the importance of your credit score. Number 4. Bad ways to save money. Number 1. Have you ever found yourself asking this question? If you have, you are not alone. There are thousands of people who find themselves looking at their bank statements or calling their banks and asking this same exact question. The problem is twofold. By this I mean, as consumers it is our money, so it is our duty to keep track of our finances, not the banks or anyone else. Most people lack the knowledge to understand that we as consumers should not be calling the bank to ask this question. We should already know the answer. Let's discuss this a little deeper. Why is it that most people don't keep track of their finances? Some of the top excuses I hear are: 1. Lack of time. 2. Forgetfulness. 3. Don't know. Lack of time. Today it is not unheard of for people to complain about not having enough time in a day to do all of things we have to do. Between soccer practice, doctor's appointments, and helping with homework, and all of the other things we have to do in any given day, it is no wonder we don't have the time to do the simple things. Keeping track of your account is really a simple task if you learn how to do it the right way. The ironic thing about all of this is that the banks give you the tools you need to effectively manage your accounts. But majority of you fail to even use a fraction of those tools. For example, most banks offer some sort of online banking option. This option makes it easy for you to monitor your banking transactions from anywhere with an internet connection. You can also perform some basic maintenance tasks without ever having to call your bank. What makes this such a great tool is that it is available 24 hours a day. So after you have had a chance to put the kids to bed and settled down, you could balance your daily expenses using this helpful tool. Note: it is important to note here that any of the tools that the bank put at your disposal are just that. Tools. They are not there to keep track of your account for you. That is your job. Forgetfulness. Let's face it, with all that is going on in our days, how can we remember every single thing that we buy in a day? It is inevitable that we will forget something, and that is one of the reasons that we find ourselves scratching our heads and asking the question, what happened to my money? Creating a system that allows for you to keep on schedule, but at the same time keeping accurate records of your daily expenses is crucial. Depending on your lifestyle, you should examine your daily routines and find a way and/or time when you can track what you spend your money on day in and day out. Don't know, this one comes down to complete and total laziness. It just couldn't be said any other way. People get lazy. It is easier to not do it and expect someone else to do it than it is to take an interest in where your money is going every single day. It goes without saying that being lazy almost always leads to more troubles. By not taking ownership of your finances, you are leaving it in the hands of strangers. My dear sweet grandma used to say, if you want something done right, do it yourself. If that ain't about right. If you want to change your life financially, you have to know where to start making changes. That simply cannot be done if you don't already know where your money is going now. Well, now that we have covered some of the more common reasons most people don't keep track of their finances, what are some solutions? 1. Hire an accountant. 2. Get off your lazy butt and do it. 3. Let things continue the way they are. Take your pick. I suggest option number 2. If you would like to know just how myself and my wife started to keep better track of our finances, visit the following link, Budgeting Basics System. Not only will you learn how to track your daily expenditures easily and quickly, but you will also receive additional tools and tips to help create the ultimate budgeting system that will have your bank account growing at an alarming rate. Number 2. As applying for loans, credit cards and other forms of credit are easier to come by, so are the bankruptcy rates in the United States. In a 10-year period, between 1994 and 2004, bankruptcy rates in the United States nearly doubled. The government's reaction was to take a closer look at reasons parties were filing for bankruptcy. New laws were instated to ensure that individuals and businesses had valid reasons for applying for bankruptcy. One of the primary laws regarding bankruptcy that was passed in the United States in 2004 is the Bankruptcy Abuse Prevention and Consumer Protection Act. This law just went into effect in October 2005, but has already caused quite a stir in the financial and bankruptcy law arenas. Besides making it more difficult to qualify for Chapter 7 bankruptcy, or complete bankruptcy, the law imposes stricter rules and budgets on Chapter 13 debtors. A major change the law makes throughout the United States is a need for debtors to have filed tax returns for 4 years in a row before qualifying for bankruptcy. As well, dischargeable debts, or those debts where personal liability is taken away by the court system, is more difficult to come by. The Act requires that debtors prove good reason for dischargeable debt and is even requiring more debtors to take responsibility with non-dischargeable debt budgets. As far as the two major types of bankruptcy laws are concerned, Chapter 13 bankruptcy is that which allows a debtor to keep some assets upon proving only limited debt and a steady income. This bankruptcy is excellent for those debtors who have gotten themselves into major financial difficulty but still have means of paying for some assets. The court will set up a repayment schedule and budget that allows for full repayment of mortgages or cars within 3 to 5 years. If repayment is simply not an option, the bankruptcy law requires that a debtor will file for Chapter 7 bankruptcy. This is often referred to as complete liquidation of assets, except for exempt items. Exempt items in a bankruptcy hearing are determined by the court and are usually items that are a necessity, such as a car or work-related items. As well, the courts will distribute debts into two categories, non-dischargeable and dischargeable debt. Non-dischargeable debts also fall into two categories, non-dischargeable due to wrongful conduct on the debtor and non-dischargeable due to public policy. Wrongful misconduct by the debtor could mean theft or laundering money, while public policy could include child support payment or court-related judgments. Keep in mind that in either type of bankruptcy, an individual is almost always required to still pay for taxes, student loans, alimony, child support or court-related fees. This is the place where many bankrupt parties are misled in the Chapter 7 bankruptcy, as it is often referred to as a fresh start. While the court can set up payment plans to help the debtor repay public policy debts, even Chapter 7 debtors will still be required to make payments. Another major point regarding bankruptcy law is that a bankruptcy will stay on a credit report for approximately 10 years. This will make it extremely difficult to become eligible for any type of credit, even a credit card, but especially for a car loan or a house mortgage. While some creditors will still offer limited credit to bankrupt individuals, the interest rates and finance charges are usually through the roof. This makes it even more difficult for debtors to get back on their feet. Last but not least, keep in mind that bankruptcy law will require any co-signers to be responsible for debt payments. If mom or dad signed for a car loan when you were young and you still owe on that car, they are liable for payments. These friends or family members who were once doing you a favor may be brought into the bankruptcy law court proceedings, which can put a strain on friendships and family relations. For specific bankruptcy law questions, it is best to contact a bankruptcy attorney or legal aid in your county or state. Bankruptcy laws and proceedings may vary slightly from state to state, so be sure to make contacts in the state where you plan to file for bankruptcy. Number 3. As recent as a few years back, the term credit score was not very commonly used in our society. While there were who understood the term and its purpose, the mass majority, although realizing that there was a system out there that their credit, they did not have a term to stick to it. Today, however, due to a number of factors such as increased identity theft and mass media marketing campaigns, there are very few who are not aware of the term credit score. The goal of this article is to add understanding on the personal to the recognition of that term. A credit score is a number between 300 and 850 based on a statistical analysis of an individual's credit activity. It is used to represent the creditworthiness of an individual. How likely that the individual will pay his or her debts. A credit score is based on their credit report information, which is typically sourced from credit bureaus and credit reference agencies, typically from the 3 major credit bureaus. Lending institutions, such as banks, finance companies, mortgage lenders, and credit card companies, use an individual's credit score to evaluate the potential risk posed by lending money to that individual. Lenders use credit scores to determine who qualifies for a loan, at what interest rate the loan is issued, and what credit limits are determined. The use of credit scoring prior to granting credit is a trusted system throughout the industry. Credit scoring is not limited to banks, however. Organizations, such as mobile phone companies and government departments, employ the same techniques. While there are many others, such as NextGen, VantageScore and the CE score, the most widely known score in the United States is FICO, which is most widely used in the mortgage industry. FICO is an acronym for Fair Isaac Corporation, the company that provides the most well-known and most widely used credit scoring system in the United States. The FICO score is calculated by applying statistical methods, developed by Fair Isaac, to information in one's credit file and is primarily used in the consumer banking and credit industry. FICO scores show how likely it is that a borrower will default. No public information is available to determine what the scores mean in terms of statistics. A separate score, BNI, is used to indicate likelihood of bankruptcy. As stated, banks and other lending institutions use credit scores as factors in their lending decisions. Whether credit is denied or approved, what interest is charged, what income level and asset verification is required is all based on an individual's credit score. The FICO score actually uses slightly different scoring methods to rate a consumer's suitability for 3 different types of credit: mortgages, auto loans, and consumer credit, each reflecting the different credit risks of these various types of lending. It is not unusual for these scores to differ by as much 50 points or more for the same borrower. There are 3 major credit reporting agencies in the United States. Although oftentimes inaccurately referred to as credit bureaus, these agencies, Equifax, Experian and TransUnion, also calculate their own credit scores. These additional scores differ depending on what they are meant to predict, what statistical methods used to determine a score, and what information is used and how it is weighted. These additional credit scoring systems are numerous and are agency-specific. For example, Beacon, Beacon 5.0, Beacon 96, and Pinnacle scores are available only from Equifax. Empirica, Empirica Auto 95, Precision Score, and Precision 03 are available only from TransUnion. And Fair Isaac Risk Score at Experian. These various credit scores are developed for the different agencies by Fair Isaac. Each differs and are periodically updated to reflect current consumer repayment behavior habits. The NextGen score is a scoring model designed for consumers. In an effort to make credit scoring more consistent across the board, in 2006 the Big 3 credit reporting agencies introduced Vantage Score. Vantage Score uses a different number range from the FICO score. It ranges from 501 to 990 and also assigns letter grades from A to F to specific ranges of scores. A consumer's Vantage score may differ from agency to agency, but the difference would be entirely due to differences in the information reported to the various agencies, not due to differences in scoring systems. Since FICO is still widely used by lenders, the agencies continue to offer FICO scores as well. Most credit scores use a multiple scorecard design. Each version may use individual scorecards, and an individual potential borrower is typically compared with other previous borrowers. In other words, a borrower with one 30-day late payment will be scored against a population with some similar delinquency. A borrower with 2 30-day late payments will be scored against a population with like credit faults. The individual is then graded according to which variables indicate a risk within that group. Nearly all large banks also build and use their own systems for credit scoring purposes, and are oftentimes in conjunction with outside scoring formulas. The systems used to generate credit scores are subject to federal regulations. The Federal Reserve Board's Regulation B, which implements the Equal Credit Opportunity Act, expressly prohibits a credit scoring system from considering any prohibited basis such as race, color, religion, national origin, sex, or marital status. It also stipulates that credit scoring systems must be empirically derived and statistically sound. In addition, if an adverse action, a denial of a credit application, is taken as a result of the credit score, then the specific reasons for the denial must be provided to the individual denied. The statement "credit score not high enough" is insufficient. The reasons for denial must be specific. Too many delinquencies 60 days or greater, and such. Credit scores are designed to measure the risk of default by taking into account various factors in a person's financial history. Although the exact formulas for calculating credit scores are closely guarded secrets, the Fair Isaac Corporation has disclosed the following components and the approximate weighted contribution of each: 35% punctuality of payment in the past, 30% the amount of debt, expressed as the ratio of current revolving debt to total available revolving credit, 15% length of credit history, 10% types of credit used, 10% recent search for credit and/or amount of credit obtained recently. These percentages offer a limited guidance in understanding a credit score. For example, the 10% of the score allocated to types of credit used is undefined, leaving consumers unaware what type of credit mix to pursue. Length of credit history is also a murky concept. It consists of multiple factors, 2 being the oldest account open and the average length of time an account has been open. Interestingly, although only 35% is attributed to punctuality, if a consumer is substantially late on numerous accounts, his score will fall far more than 35%. Bankruptcies, foreclosures, and judgments affect scores substantially, but are not included in the very vague pie chart provided by Fair Isaac. A FICO score generally has a max of 850 and a minimum of 300. It exhibits a left-skewed distribution with a median around 723. The performance of the scores is monitored and the scores are periodically aligned so that a lender normally does not need to be concerned about which scorecard was employed. Because the 3 major credit agencies have their own, independent databases, each of us actually has 3 credit scores for any given scoring system. As these databases are independent of each other, they may contain entirely different data. Many lenders will check an applicant's score from each bureau and use the median score to determine the applicant's creditworthiness. As a result of the FACT Act, Fair and Accurate Credit Transactions Act, each legal U.S. resident is entitled to 1 free copy of his or her credit report from each credit reporting agency once every 12 months. To guard against inaccurate information or fraud more often than yearly, one can request a report from a different credit reporting agencies available on the net. This information is available from a number of websites across the net that offer free credit report and use of their services for 30 days. After which, there is a monthly fee involved. The fee is nominal compared to the necessity of protecting your credit in today's highly technological society where identity theft is becoming more prevalent. In a time where identity theft and credit fraud are on the rise, the fee these firms charge seems like a small amount to pay to protect your credit and your good name. Having a good credit score is becoming more and more prevalent in our society. Here are a few examples of how. In September 2004, XU announced it would begin setting individualized electricity prices based on credit score. However, due to negative press and pressure from the Texas Public Utility Commission, the plan was not implemented. Credit scores are often used in determining prices for auto and homeowner insurance. Recently, some of the agencies that generate credit scores have also been generating more specialized insurance scores, which insurance companies then use to rate the quality of potential customers. These scores are unavailable to consumers. Many employers reserve the right to do a credit check of job applicants, in the same manner they reserve the right to drug test potential employees. The fact is that your credit score is important. Rebuild-credit.us is a site committed to providing consumers with quality information concerning credit, how to get it, and how to maintain a quality credit score. It is recommended you take the time to visit them and read through the numerous articles and reports there. Number 4. Finding new ways to save money on almost anything you buy is almost like getting a raise. Maybe it's even better. When you save $20 on a coat, you get to keep the whole $20. When you make $20 more on your paycheck, you lose $5 or more of it to taxes. Finding ways to save money can go too far, though. In a recent newsletter on how to save money, one contributor suggested getting free flowers for weddings by picking up the leftover flowers at a cemetery. She didn't say how you can tell which are leftovers. I thought I was cheap. The following are gleaned from real suggestions on ways to save money sent into frugality websites and newsletters. Some cheapskates don't seem to notice that an extra hour at work might put them further ahead than many hours of penny pinching. Ways to save money. Don't try these at home. A mother confessed that she makes her kids stuff their pockets with the free ketchup, salt and other condiment packets every time they were in a fast food restaurant. Oh, if only that were all, but no. She has the kids squeeze the contents of the packets into regular jars of ketchup and mustard too. She says she hasn't bought these condiments in years. Pride is found in strange places. One creative penny pincher found a way to save money on car washes. He washes his entire car using the squeegee at the gas station. I wonder if he takes the toilet paper rolls home from their restrooms too. Would you like a free umbrella? One man suggests getting one at the Lost and Found department of any large public library. You just tell them you lost a black umbrella. They will almost certainly have several, from which you can pick the best one and claim it as your own. What if they have no black umbrellas? I guess we'll have to wait for this guy to publish a lost umbrella color frequency chart, in order to know which color to try for the next day. Several contributors to these newsletters know how to save on their long-distance phone bills. The most common suggestion is to call people long distance when you know they won't be home, and leave a message for them. Then they pay for it when they return your call. I suppose if your timing is off, and they answer when you call, you can quickly hang up on them and try again later. I don't recommend any of these as ways to even the most frugal person. Apart from the ethical issues with some of them, they can be lumped in along with washing and reusing plastic wrap, a time-wasting frugality. On the other hand, they are fun to read, and I suppose we could view such measures as cheap entertainment as well. Perhaps you can turn off the lights to save money on electricity and tell the kids it's a game of hide and seek, or train your dog to beg from the neighbors so you don't have to feed him. I wonder how many people actually pay for magazines and newsletters that tell us ways to save money? Do these magazines advise that readers go to the library to read them, or stand reading them in the aisle at the bookstore for an hour? Those are some sure ways to save money.